Hello, this is Dr. Nunez, and this is the Chapter 4 problem solving session. So, as with prior chapters, we're going to be looking at some of the exercises that I've assigned, and hopefully, this will help you prepare to complete your application assignment and your quiz. So, let's get started with BE, Basic Exercise 4-3. So, on a classified balance sheet, I talked about this at the end of the Chapter 4 lecture. On a classified balance sheet, we will typically classify our assets into two categories, those current assets and the non-current assets, plant, property, and equipment. And then we'll classify the liabilities into two categories, current liabilities and long-term liabilities. And what's the difference? Why do we need two categories of assets, two categories of liabilities? Again, current, right? Whether it's current assets or current liabilities means that that item, for example, assets will be consumed within a year. So if it's, for example, accounts receivable, we expect those receivables to be paid within a year. If it's current liabilities like accounts payable, we expect to pay that liability within a year. Current means less than a year, should be outstanding for less than a year. Non-current means it should be outstanding more than a year. So long-term liabilities, for example, that means that, we have some debt that doesn't need to be paid within a year. It needs to be paid beyond a year, somewhere greater than a year. And the property, plant, and equipment, those are those fixed assets that we're going to hold on for years and years and years. And then we have our stockholders' equity. And remember, stockholders' equity has two divisions. It has the common stock. That's what gets reported on the balance sheet, and it has the retained earnings. So the stockholders' equity section on our balance sheet has two divisions, common stock and retained earnings, and then current assets has two sections. Not current assets, but assets has two sections, one of which is current assets, and then property, plant, and equipment, and then liabilities has two sections. So I said all that to say that those are the categories that we need in this exercise. We've got to classify all of these items that were given into the categories that were given in A through E. For example, accounts payable, where would we report that on the balance sheet? Well, accounts payable is a current liability. Right? Accounts receivable. Well, accounts receivable is an asset, and it's a current asset. Accumulated depreciation on the building, well, property, plant, and equipment is where you're going to find accumulated depreciation. And I'm just going to abbreviate that PROP. And then cash. Well, cash is a current asset. Common stock was going to be here in the stockholders' equity section. Common stock is stock equity. Notes payable due in 10 years. Here's an example of one of those long-term liabilities. So a long-term liability is this liability that's not due until 10 years. Supplies is a current asset. And wages payable, well, we certainly have to pay our wages within a year. So that's going to be a current liability. And that's it, just those 8 line items. Okay, and then we'll have an opportunity to actually prepare our balance sheet a little bit later. Next one, closing entries. So in the chapter 4 lecture, I talked about preparing the 2 required closing entries. It's a 2-step process. We need to be able to close out the revenue and expenses in the first step. And then the second step, we want to close out the dividends. So let me try and identify the items that we need here. So fees earned is our revenue account. We've got to close that out. And then we've got 4 expenses here, right? So all of these, I won't label them individually, but I'll group them all together. Those are all the expenses. And then we've got the dividends account that we need to close out. So let's put it all together in this 2-step process. So the first thing that we need to be able to do here is close out revenue. And there's only one revenue account, and it's fees earned. It normally has a credit balance, so to close it out, we're going to debit it for 975,000, whatever the balance is. Because the objective, remember, is to zero out the account. And then we want to close out the expenses. Remember, expenses normally have a debit balance, so to close them, we'll be crediting them. So I'll do them in the order that they're listed there. We've got this wages expense. And the wages expense is 580,000. 580,000. And then the rent expense is 120,000. And then the supplies expense is 31,600. And then the miscellaneous is the last one. That is for 231 or 31,000. The miscellaneous expense, I'm sorry, is 12,400. 12,400. So we've got all of our revenue and expenses. Remember, revenue has a credit balance. To close it, we debit it. Expenses have a debit balance. To close them, we credit them. And then now we're supposed to balance this entry by closing everything out to retained earnings. So here's what we need to be able to do. Let me go ahead and get my pencil here. We need a total of all of these expenses. And we want to compare that to the revenue. So what we've got here is we've got some revenue that is 975,000. And the total of these four expenses, add all four of those, and what we get is 744,000. So the difference between the revenue of 975 and the expenses of 744 is $231,000 of income, right? Revenue minus expenses gives us income. That's what that equals. And that's what goes to retained earnings. Retained earnings is going to be $231,000. We want to make sure that we close out that retained earnings for the difference between the revenue and the expenses. So now we've closed fees earned, we've closed those four expenses, and we've moved the income into the retained earnings account. That's step one. Step two now is to close the dividends account, which normally has a debit balance. So to close it, we need to credit it, and we'll be debiting retained earnings for $30,000. How do I know that? Up here. Dividends, we identified 30,000. And again, our credit is to dividends for 30,000. And that's the two entries that are required to close the accounts. That's it. And we have a couple more of these to give you some more practice. But that's all that's required for this one. Okay. Next, we need an income statement. So we have an opportunity here with a couple of exercises to prepare an income statement. And this income statement, remember income, all we're doing in income is we are summarizing the revenue, summarizing the expenses, and taking the difference between the two. And if the revenue is greater than the expenses, we've got income. If the expenses are greater than the revenue, well, then we've got a net loss. That's all we're doing. So again, you want to make sure that you can identify the revenue. And that's pretty easy here, right? The same thing. It's the fees earned. So this is our revenue. And everything else, those are expenses, right? Depreciation, insurance, miscellaneous, rent, salaries, supplies, utilities, those are all the expenses. So on our income statement, all we're going to do is start with that revenue that we call fees earned and then subtract all the expenses. Now, what order should we use? Because these are kind of all over the place. Typically, we list expenses in order of magnitude. That means start with the largest one and work our way down to the smallest one. The largest expense is salaries right here. That's our starting point. We're going to start with that. And then we'll move to the next largest expense, which is rent. That's 75. And then we'll keep going in that fashion. I'm not going to type all this out. I have the solution below. Let's go ahead now and take a look at it. So this is our income statement. And I've done exactly what I just discussed. I started with the fees earned of 875,000, and then I've listed all of the expenses in order of magnitude. So notice it's from the largest salaries down to the smallest, which is insurance. And notice there's this miscellaneous here at the bottom. Now, why is that out of order? Because technically it should be higher up if we're going in order of magnitude. The exception is always miscellaneous. Miscellaneous is always at the bottom. So all the other expenses are listed in order of magnitude with the exception of miscellaneous. That's usually just kind of thrown down at the bottom. Okay. So we've got fees earned of 875. All of these expenses add to 635. Revenue minus expenses gives us income. So again, whenever the revenue is greater than the expenses, we've got income. That's all the income statement is. This is a very simple income statement. It's called a single step income statement. There's just one step to determine income. Subtract the expenses from the revenue. Okay, let's do another one. So in this case, we're asked to do exactly the same thing, prepare an income statement. We need to be able to identify revenue. It's right there. So now we've got what we're calling service revenue. And then we've got all of these expenses, right? All of these expenses. And we want to list these in order of magnitude. That means we're going to start here with wages. And then we'll go over here to rent and we'll work our way down from the largest to the smallest and put the miscellaneous at the bottom, right? Just throw that in at the bottom. That's all we're going to do. Same thing we did on the last statement. So again, here's our income statement. We start with that revenue, right? Revenue minus all of these expenses. Order of magnitude. Start with the largest, work our way down, put the miscellaneous at the bottom. So the revenue minus the expenses gives us not income. We have a net loss, right? The expenses are actually greater than the revenue. And that's what you see here, right? We've got $684,150 worth of expenses, but we only have $634,900 worth of revenue. We've got a net loss. So it's just the opposite of what we saw in the last exercise. The expenses exceed the revenue, hence we have a net loss. But the method is the same, right? Summarize revenues, expenses, take the difference between the two. Okay, let's just do one more of these. And then we'll move on to the balance sheet. So again, we need to prepare an income statement. We want to make sure we're able to identify the revenue, right? So we got some revenues. It's just called revenues, or $50,365. And then we've got some expenses that we're going to list in order of magnitude. And there's the first one, salaries and employee benefits, 18,581. And then from there, we'll go to the transportation and then work our way down to the smallest one. And if we had a miscellaneous, we'd put it on the bottom. In this exercise, they're just kind of identifying it as other. So what I usually say is we list the expenses in order of magnitude with the exception of miscellaneous and other. Miscellaneous and other always go on the bottom, right? Everything else, all the other expenses get listed in order of magnitude. Miscellaneous and other are listed at the bottom of the summary of expenses. So let's scroll down here and take a look at this income statement. There's our revenue, right? And then we want to list all those expenses in order of magnitude. Put a total in for the expenses and subtract it from the revenue. We've got income because the revenue exceeds the expenses. 50,365 of revenue, 48,545 of expenses. And that's what we need. Okay, so let's take a look at the balance sheet. And I am not going to prepare the balance sheet because there would be too much typing, but I'll kind of talk through what we have to do here on this balance sheet. So again, on the balance sheet, we are reporting on the assets, which of course have to equal the liabilities plus the equity, right? And equity has two divisions. It has common stock and it has retained earnings, right? That's what our stockholders' equity. Our stockholders' equity is common stock and retained earnings. And in assets, we have two divisions. We have current and we have the PP&E, plant, property, and equipment. Liabilities, we have two sections, current liabilities and long-term liabilities. So basically, there are two sections for each one of these elements, right? Two sections for assets, two sections for liabilities, two sections for equity. And we want to make sure that we can identify all of the assets, liabilities, and equity. So the assets are pretty easy, right? We've got some accounts receivable. We've got cash. We've got equipment. And we've got accumulated depreciation that goes with that equipment. And we've got some land. And we've got some prepaid insurance. We've got some prepaid rent. And we've got some supplies. Those are all of our assets. And we want to be able to identify those assets that are really kind of current or not PP&E. The only PP&E we have would be, this land, right, is kind of a plant, property, and equipment. It's non-current, right? The equipment, PP&E, plant, property, and equipment, is going to be one of those non-current assets. So we've got the land, the equipment, and then the accumulated depreciation that kind of goes with that equipment. All those other assets are current assets. So I've identified all the assets and I've split those assets into two categories, right? You've got the plant, property, and equipment, right? So the P, P, and E goes here, and then the current assets that goes there. And then the liabilities. Well, liabilities, uh, we've got accounts payable, right, which is a liability. And then let's see, we also have salaries payable, which is a liability, and we have unearned fees, which is a liability. And all three of those are current liabilities. We don't have anything that they've identified as kind of a long-term liability. All of those are current liabilities. We don't have anything else here. There's nothing else here. And then of course there's the common stock and there's the retained earnings. So that's everything. Now the only hiccup, if you will, in this problem is they have not given us a cash balance. They've kind of given us a question mark here, which means we need to try to figure out what that cash balance is. And it's not that difficult. It just takes a little bit of work, but it's really kind of based on the accounting equation, right? We know that the assets have to equal the liabilities plus the equity. That's what we know. We know that the assets have to equal the liabilities plus the equity. Well, we kind of have most of the information that we need. So if I switch here to the typewriter mode, we we only have three liabilities, right? We have the accounts payable, the salaries payable, and the unearned fees. So, we have here the 41.2. And then we also have the 3,800. And then we also have the 13,500. And where am I getting these numbers from? Well, they're numbers that are identified up here. Accounts payable of 41,200, the salaries payable of 3,800, and the unearned fees of 13,500. Those are the three liabilities. And the equity, well, we have the common stock of 90,000, and we have the retained earnings of 6,015. So again, what we're saying here is that all of these plus all of these is what the right side of this equation has to equal, right? All of the assets have to equal the liabilities plus the equity. And all these liabilities are 58,500. All the liabilities, if you add those three numbers, you get 58,500. And that plus the equity, if you add those two equity, you get 691,500. So what we're saying here is the assets, right? All the assets that we have listed up here, right? This, all those assets, right? Even though we don't know what cash is, we know that all the assets plus whatever cash is, right? We don't know what cash is, but whatever cash is, right? Assets plus cash are going to have to equal the 58 plus the 691,500. So the assets plus the cash, whatever that is, are going to have to equal, well, 58,500 plus 691,500 is $750,000. Right? Basic accounting equation, kind of like what we did in chapter one. We don't know what cash is, but we know what A is. And I'm not going to list all of them. There are several of them. 1, 2, 3, 4, 5, 6, 7, 8. We got 8 of them, right? And remember that accumulated depreciation is what we call a contra asset account. A contra asset account normally has a credit balance. So really you should be thinking about this as being an offset to the equipment account, right? That's going to offset the equipment account. So it's 230 minus 45. So what we have here is we have all of these assets. If you add all those assets together, and I'm just going to go ahead and fill that in. If you add all those assets together, all the ones I identified, you end up with 650,000, again, plus whatever cash is, right? Has to equal, in this case, $750,000. So all those assets plus whatever cash is has to equal $750,000. So what's cash? Well, again, cash is an unknown, but we know that that cash is going to have to equal 750,000 minus the 657. So what does cash equal? So cash equals this question mark. 93,000. Cash is 93,000. So it's a little bit of work to get to this number. If you have any questions, don't hesitate to reach out to me. So put it all together, right? I've identified the equity, I've identified the liabilities, I've identified all the assets, and I've solved for cash. Put it all together on this balance sheet, and here's what you get. Cash, 93,000. Accounts receivable is given, supplies are given, prepaid insurance is given, prepaid rent's given. That's the total of all the assets. Plant, property, and equipment, all of that's given. We got the land of 320, equipment is 230. Subtract the contra asset account, accumulated depreciation, so that this equipment has a book value of only 185,000. So we've got cash, we've got plant, property, and equipment. All the assets are 750,000. And that just equals the liabilities, 3 liabilities, and 2 equity, which equals 750. So the total assets equals the liabilities plus the equity. right? That's what we do on this balance sheet. We want to make sure that the accounting equation is in balance. All those assets, right? All those assets has to just equal the liabilities plus the equity. And we are in balance. Okay? So that's our balance sheet, and that's the only balance sheet that we're going to do in this chapter. And then the last couple of things that we have are just a couple more examples of closing entries. So I'll go ahead and do the closing entries so that you have another chance to see those closing entries, the two-step process. So in this one, exercise 415, again, we need to use that two-step process to close these temporary accounts. So we want to make sure that we're able to identify the revenue, and then we've got all of our expenses. All of these items are the expenses that need to be closed out. So those are the expenses, and then this one is the dividends. And all we're going to do is in a two-step process. First, we close the revenue, right? So we close this fees earned, which has a balance of 614.5. And then we want to close out those expenses, and we'll start with the rent expense. We'll use the order that they're given in. So the rent expense. The rent expense is 140,000. And then we're going to close out the supplies expense. And supplies is the 18,200. And then we'll close the wages expense. And wages is 320,000. And then the miscellaneous expense. And the miscellaneous expense is 8,700. And again, as we did with the other exercises, what we need to be able to do here is make sure we close these expenses and the revenue out to retained earnings. So what we have here is we've got the fees earned of 614.5. That's all our revenue. And we're going to subtract all of these expenses, which add to 46,900. So that what we're left here with is that income, which is 127.6. And that's what goes here. That's our credit to retained earnings. 127.6. And now we've closed out the revenue account. We've closed out the expenses. We've closed everything out to retained earnings. And the last thing is to close dividends. So now dividends normally has a debit balance. To close it, we're going to credit it. And we debit retained earnings for 45,000. And we close dividends for 45,000. And that's our two-step process, closing entries. And we have net income. So we've not yet seen closing entries with a net loss. That's the last thing that we're going to look at. Closing entries with a net loss. So in our next exercise, in 416, now we've got a situation again where we need to be able to close out these accounts. We've got our revenue here. And then we've got, an expense here. And then all three of these are expenses as well. So the revenue, the expenses, the dividends, we're going to close all those out. So that two-step process means the first thing we'll do is we'll close out revenue, fees earned. normally has a credit balance. To close it out, we need to debit it. So we're going to be debiting this account for 1,150, $1,150,000. Now, we already know because it tells us up here that there's going to be a net loss here. So I'm going to skip this line here. I'm going to leave this blank and come back to it. But we need to close our expenses out, and I'm going to start here on the next line. And the first one I'm going to list is the rent expense. Rent expense is $5,000. Normally has a debit balance. To close it, we're going to credit it. I'm sorry, rent is $200,000. And then after that, we've got the supplies expense, which is $19,300. Excuse me. And then we also have some wages. And the wages are $915,000. And then lastly, we have the miscellaneous. And that's 31,900. Okay, so we have debited the revenue account and credited the expense accounts. So again, we've got $1,150,000 of revenue. And then we've got all these expenses. So we have to summarize all these expenses, right? Add these four numbers. So the expenses total 1,166,200. Those are the expenses. So what you should see here is we've got expenses that are greater than our revenue. Expenses are 1,166,200, and the revenue is only 1,150,000. We've got a loss of $16,200. A loss of $16,200. So all the credits are greater than the debit. That means that we need to debit retained earnings, not credit it. Debit retained earnings for the $16,200. And now the entry balances. The sum of the debits equals the sum of the credits. That's what we have to ensure. In this entry, the sum of the debits always needs to equal the sum of the credits. When we have income, we're going to be crediting retained earnings. When we have a loss, we're going to be debiting retained earnings. And then the second step is we got to close out that dividends for $5,000. And the way we close out dividends is by debiting retained earnings. We're going to debit retained earnings for $5,000. And we're going to credit dividends. Dividends normally has a debit balance. To close it, we're going to credit it. Credit dividends for $5,000. And that's an example of closing entries with a net loss, right? Our expenses exceed our revenue. And that's it. That's it for chapter 4. Certainly, if you have any questions, don't hesitate to reach out to me, and I'll see you in chapter 5. Actually, chapter 6 is our next chapter. Take care.